How does cash flow analysis impact agricultural loans? Imagine trying to grow a farm without knowing how much money will come in and go out each month. It's like sailing a boat without checking the weather forecast. Cash flow analysis is the tool that helps farmers and lenders see the financial weather ahead. When farmers apply for agricultural loans, lenders want to know if the farm can pay back the money. Cash flow analysis provides that answer by showing the farm's income and expenses over time. Farmers earn money from crop sales, livestock, and government payments. They spend money on seeds, equipment, labor, and land costs. Cash flow analysis tracks when money is received and spent, which helps identify busy months when cash is plentiful and lean months when cash might be tight. This is especially important because farming depends heavily on seasons and weather conditions. Lenders look at cash flow statements to decide if a farm can handle a loan. If the farm's cash flow is steady and positive, it's easier to get approved for a loan. Better cash flow means the farm can comfortably make loan payments and still cover daily expenses. If cash flow is uncertain or negative, lenders might offer smaller loans or higher interest rates to cover the risk. Cash flow analysis also helps determine how much debt a farm can take on. It shows the maximum loan size that the farm can repay without risking financial trouble. This helps farmers avoid borrowing too much, which could lead to trouble if cash flow drops unexpectedly. Another key point is how loans are structured. If farmers know when their cash inflows peak, like after harvest, they can schedule loan payments during those times. This reduces the chance of missing payments and helps keep the farm financially healthy. Farmers can also use cash flow projections to plan for future investments. Whether it's buying new equipment, expanding land, or upgrading infrastructure, understanding cash flow helps decide the best timing for these expenses. It also helps prepare for unexpected costs, like repairs or bad weather, by modeling different scenarios. Interest rates can change, and higher rates mean higher borrowing costs. Cash flow analysis shows how these changes could affect the farm's ability to pay back loans. Farmers can then adjust their borrowing strategies to stay profitable. Using lines of credit is common in farming. Cash flow analysis helps identify months when cash might be low, so farmers can draw on short-term credit wisely. Managing this credit carefully keeps interest costs down and maintains liquidity. Finally, cash flow analysis influences decisions on capital investments. Since farming involves buying land, equipment, and infrastructure, knowing when and how much to invest is vital to avoid financial stress. Farmers who keep detailed cash flow records are better prepared to negotiate loans, plan their finances, and make smart investments. For farmland investors and those watching agricultural real estate trends, understanding how cash flow impacts loans is essential. It affects land values, farm profitability, and the overall health of agricultural businesses. In short, cash flow analysis shapes how lenders view risk, helps structure loans, and guides farmers in managing their money. This financial insight is key for anyone involved in farmland investment and agricultural real estate, ensuring operations stay sustainable and profitable.